Everybody, today we're going to go over the simple moving average, also known as the SMA, and what exactly it is. It's an extremely simple indicator, and some of the pros and cons of using it and how other market participants use this indicator, and really the right way to use this indicator. So to start off with, as I mentioned, this is the simple moving average, and it's essentially just an average of the last X amount of days. So I mean X amount of days being however many days you're looking back. So in this case on the chart, I have the 20-day, the 50-day, and the 200-day SMA. And essentially, if you're looking at the 20-day SMA, you're just looking at the average of the last 20 closes, and that is essentially what that data point is for the 21st day. So it's really just an indicator that's looking at the last 20, in this case 20 periods, and since we're on a daily chart, the last 20 days. If you're on a 5-minute chart, it would be the last 5-minute candles, the last 25-minute candles. So really, what exactly is it and why is it helpful? So a lot of people use moving averages as potential resistance and support, and that is something that you definitely can use, especially if you're using an extremely popular SMA. So for example, the 20, the 50, and the 200-day SMAs are very popular. So using them as potential support or resistance definitely makes sense. And you can see here on the micros, you can see that we did actually have a perfect level of support here, pretty much using the 200-day SMA back in October of 2023. That's when I'm doing this video. So there is definitely not a reason to not use the 200-day SMA or the 50-day or the 20-day SMA as potential resistance. That's definitely a legit way to use moving averages. Now the problem with that is they don't really have a lot of backing behind them, like the VWAP. The VWAP is actually the equilibrium price of the last 20 days, or if you're using an anchored VWAP, since a particular pivot point. A moving average is really just a number, and the reason it is potentially a support or resistance area is because it becomes a self-fulfilling prophecy. As you can see here, once again, back in August of 2022, the 200-day acted as a perfect level of resistance. So definitely am not taking anything away from using moving averages as potential resistance and support. That's definitely something that you can utilize, especially when you're using very popular indicators like the 20, the 50, and the 200. Now, if you're using a very random indicator, maybe let's say the 31 EMA or the 32 SMA, something that a lot of people don't use, then it's a lot less likely to be used as a potential resistance or support because it doesn't become a self-fulfilling prophecy. If you don't have a lot of people watching that particular indicator, there's not really a reason for a lot of people to jump in and buy when price is testing a really arbitrary SMA. So you definitely want to use an SMA, especially the 200. The 200 and the 50 are definitely great resources to look at and have on the chart for potential resistance and support. But I would definitely say VWAP and anything that really has volume backing it is something that can act as a lot stronger of a resistance or support zone. But the 200-day definitely is something that's extremely popular and becomes resistance or support a lot of the time. Now, these are the ways that a lot of people use this. The real way that moving averages are really meant to be used are a gauge of trend. So is the moving average moving up? What's the slope of the moving average? Is it flat? These are things that can really gauge the trend, and a lot of trend following systems use these moving averages as essentially an indicator to indicate, are we in a strong uptrend? Are we in a strong downtrend? Are we pretty much in range bound trading? And each indicator is going to give you a different perspective on trend. So the 20-day SMA is definitely going to give you a much shorter time frame for trend. And the thing is, a lot of people forget that you can have essentially each time frame can have its own trend. You can be in a strong uptrend on the 200-day look back, the longer term look back, but you can be in a short-term downtrend over the last 20 days. So these different moving averages help you gauge what time frame you want to be looking at the market in. If you're looking at the market on a longer term scale, you may not really care about what the 20-day SMA is doing. You may not even care what the 50-day SMA is doing. You may only really care about the 200. And so it really depends on what time frame you're looking at. But you can use all of these in conjunction in order to get an idea of the short term, the medium term, and the long term trend, all by having these on the chart. And so one thing that I wanted to point out here is really the 200-day is a great indicator, as I mentioned, for the longer term trend. And you can see here, you've got really three different ways to look at this. You've got, let me adjust here. You've got a strong uptrend, pretty much from COVID all the way up to around the end of 2021 into 2022. And then you can see as we got to move down, notice how the SMA, even though we got to move down, notice that the 200-day is not declining, but you can see that the 20-day and the 50-day SMAs are declining. So the shorter term SMAs are really going to help you gauge when is the shorter term trend changing. And then you can see here as we started to pull back and we started to trade at a lower price area, notice how the SMA 200 or the 200-day SMA is flattening out. And so really whenever you have the SMA increasing, you're in an uptrend. Whenever you start to flatten out, regardless if you're on the 200 or the 20 or the 50, you really are starting to lose that trend. And you can see here that we really started to flatten out back in April and May of 2022, and then we continued down. As you can see here, as we continued down and hit new lows, the 200-day SMA started to decline. And you can see here as we moved down and had a really strong move up in July to August of 2022, price moved right up to the 200 and continued down and actually hit new lows into October. Now what's interesting is notice as price starts to hold the lows, meaning that we didn't put in new lows into the end of the year in 2022, notice we kind of become range bound here. You're essentially trading within a relatively defined range here, and I'll highlight that here. You were pretty much trading in this range right here. And no range is going to be perfect, but you can see we were kind of trading within this general area. And when you're range bound trading, especially a longer term moving average like the 200 is going to start to flatten out because all of these data points are now starting to trade within the same area. And just based on the math of the moving average, based on just averages in general, as you get more days that are trading within the same price range, notice how the moving average starts to flatten out. And this was a general indicator that we may be starting to reverse and we may be starting to move to the upside. Notice here how we had higher lows put in place back in January of 23, back in March of 2023. And so you could see that an uptrend was starting to form, but the 200-day definitely was lagging that a little bit. So that's how you can then go into the medium-term trend. Notice here how the 50-day really started to increase back in December of 2022, January of 2023, and you can see that it starts to increase. Now, the 20-day SMA is definitely a little more volatile, and you can see here that it's really just moving with the market. If the market's moving down within the last 20 days, you're generally going to see this move down. You're not going to have that kind of sensitivity with the 50-day moving average or the 200 because they're a little more lagging. They have more data points that have to come in to really move to change that moving average. So being able to use a moving average in conjunction with a longer term moving average or a shorter term moving average can really give you an edge so you can see all different perspectives of the chart, not just one single perspective, not just one time frame. So, that is really the key to moving averages. One, they can definitely be used as support and resistance, but two, they can really be used in a more what's the word? A lot more of a logical way, because as I mentioned, at the end of the day, a moving average is just a number. There's nothing really backing why price should bounce at a moving average other than it becomes a self-fulfilling prophecy because you're using a very popular indicator like the 200 or the 50. Now, as I mentioned, if you're using a very arbitrary moving average, you're likely not going to be able to use support or resistance in any type of way that makes any type of sense. Now, there's always going to be a time when price is going to respect a random moving average, but it's likely just coincidence. That is really why you want to use moving averages, simply to gauge trend. And if you are looking at a moving average to look for support or resistance, you definitely want to use the most popular ones, the 20, the 50, the 200. Those definitely become self-fulfilling, and you can use moving averages in other ways. You don't have to use the 20, the 50, and the 200. If you want to gauge trend based on your particular three types of moving averages for short term, medium term, and long term, you can definitely do that as well. These are just the main ones that you can use both as trend following indicators, but also as potential support and resistance. So moving averages that are very popular can easily be used as support and resistance, as well as trend indicators. Moving averages that a lot of people are not using are mainly just better for trend following rather than using them as potential levels of support or resistance. So hopefully this video was helpful in understanding really why moving averages are more of a trend following indicator versus support and resistance. And hopefully, if this video is helpful, like and subscribe, and we'll definitely have more videos coming out highlighting other indicators to use in the market and how to use them correctly and incorrectly.